Capital structure is how companies finance their operations. In this lesson, we're going to learn how companies finance their operations, predominantly through the view of how lawyers get involved. Lawyers are involved in capital structure because they're responsible primarily for actually writing the instruments that allow a company to go in and out of corporations and other businesses. So it's very important for business lawyers to understand some basic principles in business that relate to capital structure and capital formation. In this Module 1, we'll introduce by scaffolding the lesson, discussing what resources are available to us, and looking at some basic concepts that will help us communicate with our business clients and to understand the future lessons that we'll learn. We have 6 video resources that we'll review in this lesson. First is the one you're watching now, the introduction, which discusses why businesses need capital and covers some key terms that you'll need to know. Next, we'll learn about debt. Debt can come from banks in the form of bank loans, but it can also be lent from other people. Third, we'll learn about equity, which is often the form of stock, which is a percentage of the company that's sold to investors in return for cash coming in. Fourth, we'll learn about a special instrument called convertible stock or convertible notes, which is a sort of hybrid between debt and equity. And that allows people to make certain types of investments that are helpful when a company is very young or when the price is uncertain. In Module 5, we'll learn about internet crowdfunding, particularly equity crowdfunding, which is raising money from a large group of people over the internet and was enabled by the Jobs Act of 2012. Then we'll conclude on how businesses raise capital with a discussion about how lawyers can help clients make decisions about how to structure their capital and how to go about doing the corporate financing. Other resources are available for you online if you're in my class, so please visit my website for more information. Let's get started with discussing why businesses need capital. What is capital anyway? Well, it's cash, cold hard cash, and businesses need cash for a variety of reasons. They need it to begin. Starting up a company is expensive. You have to pay lawyers like us to file all this paperwork. And states like Delaware, where you incorporate, will take some fees. In addition, you might have to put a security deposit down for rent. You might have to pay for certain equipment, like a car that you're going to drive around to do your business, or for the initial inventory that you're going to sell. But companies also need money to expand. Let's say you have one office, and you think you can make more profit by having 2. You may not have the money on hand today to open a second office, but investors might be looking to help you out. And companies also have cash flow needs. Every month, bills come due. Every 2 weeks, employees need to be paid. The failure to meet these obligations can be big trouble for a business, so sometimes they need capital on a much more urgent basis. There are many reasons why companies need capital, but let's briefly turn to how investors would decide whether or not to give it to them. This has to do with an important economic concept called the time value of money. In a very short way, money today has more value than the same amount of money tomorrow, provided that we're in a normal economy with positive interest rates. To put this in a more technical way, present value is greater than future value. The present value of $1, meaning having a dollar in your pocket today, is worth more than having a dollar in your pocket tomorrow instead. That's because there are things you can do with that dollar today to turn it into more than a dollar tomorrow. Thanks to the miracle of compound interest, money compounds when it's invested. You can take that dollar in your pocket today, and you can put it in a bank and earn some amount of interest. Tomorrow will be worth more than today, just by virtue of having left it in the bank. So you'd rather have the money today than money tomorrow, all else being equal. So, to put it conversely, money in the future is discounted. We can apply a formula to determine how much money in the future would be worth today. We'd have to receive more money in the future in order to be happy with that versus the same amount of money today, but we can also look at it as a discounting problem and say how much less money would we take today in exchange for that amount of money in the future. We won't worry about the actual formulas today. Just understand the concept that because of time value of money, you would rather have money today than tomorrow. You might make your decision based on how much you can get for that money if you put it in a bank or if you invest it with the federal government. Investing with the federal government is widely regarded as the least risky thing you can do with your money. You can buy U.S. Treasury bonds or T-bills, which are backed by the full faith and credit of the American government. And so those investments will pay out at a very certain rate at a very certain time. You can feel almost sure that you're going to get that money. So if you're going to invest your money anywhere else, you're going to need to get more than that interest rate. Why would you give your money to someone who's riskier than the federal government if they're going to pay you the same as less? Rationally, it doesn't make sense. We need to look at our risk-adjusted return on capital to decide whether or not we're going to invest in a particular business. The risk-adjusted return on capital is how much we expect to get plus how much risk we take that we won't get it at all. Very early, very young companies might promise you way more interest than the federal government, but there's also a lot less chance they'll still be around when it comes time to collect on that money. The more risk you take, the more return you have to demand in order for your risk-adjusted return on capital to be at parity with the risk-free interest rate. Mr. Wimpy offers to pay you on Tuesday for a hamburger today. Well, we already know that that's not a good deal because we might not get paid on Tuesday. Mr. Wimpy's not as reliable as the federal government. We'd much rather have the money today. The question is how much money? Well, we would look at Mr. Wimpy's risk rate. Maybe he has a FICO score that shows how often he pays back his debts. We could use that or other factors to decide how much we'd have to charge him in interest in order to lend him the money for a hamburger today that he'll pay back on Tuesday. But in any event, it's going to be much higher than what we would get from the U.S. government because there's a chance he won't pay us back at all. That chance is the risk rate, and we need to adjust our return on capital based on it and make sure that when we come down with the math, we end up positive. Otherwise, we should just be buying treasury bonds or finding something else to invest in. But we don't just invest by making a loan which bears interest. We can also invest in a company on an equity basis where we buy a percentage of it. In order to do so, we have to know what the entire company is worth. There are 3 ways that we can determine what a company is worth, and they all have their own pros and cons. An asset-based approach uses intrinsic data to reach an absolute result on its value. In this case, we add up the value of all of the things a company has, all of its pencils, computers, cars, laptops, and buildings. We determine what those things are worth and we add them together, and we say that's what the company is valued at. This has a few problems. One is it's hard to know what things are really worth until you go to sell them. The market value of something, how much it's worth when you actually sell it, requires you to figure out essentially what it's worth compared to what else is out there. For some things which are commodities, this is pretty easy. You can go to eBay and see what a 2012 MacBook Pro in good condition is selling for, and you can look at Kelley Blue Book for the value of a 2012 Ford Escape. But what about some kind of patent that you might have? Or a computer which is a unique one, a supercomputer or a mainframe, or some resource that is used by your organization differently than how most people would use it? The whole is often greater than the sum of the parts, and the asset-based valuation misses this. The other problem with asset-based valuation is if you use something called book value. Book value is an accounting fiction. Essentially, when accountants figure out what a company is worth today, they look at what you paid for the assets in the past and depreciate them or decrease them on a percentage based on a schedule that is in generally accepted accounting principles. The amount of depreciation that you find on a car, for example, may have very little to do with the actual market value of that car. The depreciation on cars is the same, whether they're Fords or Mercedes or Ferraris. But it turns out that Fords and Ferraris actually depreciate at different rates based on the market value. In fact, some exotic Ferraris will go up in value in the market, whereas the book value will show it goes down. A Ford may lose its value more quickly or more slowly than a Mercedes or a BMW. In any event, market value and book value are not necessarily the same, and using either of these ignores the fact that the whole is greater than the sum of the parts. We can try to look at the whole by taking a market-based approach that uses extrinsic data to get a comparative result. What this means is we look at companies that are similar. We do comps or comparables to figure out what our company is worth. The example that most of you may be most familiar with is looking at real estate. If you go to buy a house, the agent will show you what other houses in the neighborhood sold for. No houses are completely alike. Even ones all built on the same model are on different plots of land and have different amounts of use on them. So, how much is your house worth? Well, let's say it's a 4-bedroom house, and the 3-bedroom house down the street sold for $100,000, while the 5-bedroom house sold for $300,000. Your house might be worth $200,000, or at least somewhere in between, but is that a really good comparison? Maybe different types of families are buying 3-bedroom and 5-bedroom houses. Maybe your bedrooms are nicer, or you have marble floors instead of wood, or you have a patio where the others don't, or a 2-car garage, or a driveway, or many other factors. We can try to add or subtract from the value of our asset compared to comparables based on these, but it involves a certain amount of guesswork. Plus, it's not clear exactly what comparables to include. Do you add the house down the street? What about the one 5 blocks away? Or 10 blocks away, or over the train tracks, or on the other side of a river? Where do you draw the line on what's truly a comparable to the asset you're trying to value? It can be very hard. It can be even harder in the case of companies. How much is Microsoft worth? We could look at what Dell and Apple and HP are worth, but are those companies real analogs to Microsoft? None of them do exactly the same thing. Some are more based in software as a service. Others do more hardware. It can be very hard to take a market-based approach, but it's easier in public markets where companies are traded on the stock market. In those cases, we can use certain formulas like price-to-equity ratio or earning before income, depreciation, taxation, and amortization to figure out whether a company is worth more or less than its peers. But the problem with all these approaches is it requires some guesswork to determine what companies are truly comparable with each other. It's not always entirely clear. Let's go back to looking at intrinsic data. We can use our income-based method and project forward how much we think our company will earn in the future. But this requires some extrinsic assumptions, like how much the demand for our particular good will increase or decrease over time. And since we're projecting into the future, we need to use that same time value of money concept we used when thinking about making a loan. Income in a year, or in 2 years, or in 3 years is discounted versus income today. But we don't know how much the interest rate is going to change between now and then, and it's hard to be sure exactly what the risk of this company is. So while it may seem like we reach an absolute result that's reliable based on using income data and projecting our current income to determine our future income streams and discounting it, in reality this requires making quite a number of extrinsic assumptions about the state of the world. The demand for our cars, for example, may depend on how much OPEC decides to produce oil this year or next year. And there's really no way of figuring that out with a certainty. So the income-based method falls a bit short too. Still, it's considered the gold standard, and the income-based method, when done right, is generally regarded as the best way to determine how much a company is worth today by discounting its future cash flows to present value of that amount of money. Let's recap what we learned in this module. First, we discussed how to access the resources for this chapter through 6 videos and online content. We discussed why businesses need capital to start up, expand, and meet cash flow needs. We learned that money today is worth more than money tomorrow, but how much more depends on interest rates and risk of the particular investment you're considering. And we learned that valuation of companies can be both a science and an art. It's inherently imperfect, and so our business clients are making certain guesses that we can help them with, but is essentially their decision. I look forward to joining you in Module 2 when we discuss debt. I'm Professor Seth C. Ornberg. Thank you.